Okay, what if I told you there's an insurance company out there carrying a rock-solid A rating for excellence, mind you, that's currently throwing off a massive dividend yield of over 5%? Sounds like a literal unicorn in this market, right? Well, what if I also told you that this exact same company is harboring a ticking time bomb right beneath the surface? Welcome to today's Explainer. We're going to unpack the mystery behind a wildly fascinating deep value play that pairs mouth-watering metrics with some frankly serious structural risks. Let's get into it.
Picture this for a second. We're looking at a company completely ignored by Wall Street, the major financial media, crickets. Mainstream analysts, they aren't even talking about it. It's practically invisible to your everyday investor. And whenever you hear about an A-rated financial institution paying out a strong yield that absolutely no one is paying attention to, it instantly sets off that classic too good to be true alarm in your head, right? So the big question is, why on earth is the market completely sleeping on this one?
0.57x. That is the company's price-to-book ratio. To put that in plain English, it means you can buy into this company for merely 57 cents for every single dollar of its book value. You're quite literally buying assets for almost half their stated price. I mean, think about that. In today's market, finding an A-rated financial stock trading at that kind of steep discount is like finding a needle in a haystack. It's incredibly rare, and it makes this whole setup so intriguing.
But hold on, because the mystery actually deepens from there. $0. Yep, zero. This company carries absolutely zero long-term debt on its balance sheet. And that creates this massive, immediate cognitive dissonance. Think about it. How can a company with no long-term debt, a fat 5% dividend, and an A rating be trading at barely half its book value? Normally, the market heavily rewards a fortress-like balance sheet like this. But here, it's severely punishing the valuation. It just doesn't add up.
All right, let's talk about the catch. Because, let's be real, there's always a catch. It turns out a private equity giant named Fox Paine owns a massive 43% of this company. Combine their stake with the second largest shareholder, and boom, over 60% of the voting power is totally locked up. That leaves a measly 40% for retail and other independent investors. Meaning, regular shareholders are completely overshadowed. So the biggest risk here actually isn't hiding on the balance sheet at all. It's sitting right there in the boardroom.
Okay, time for the big reveal. The identity of our hidden insurer is Global Indemnity Group, trading under the ticker GBLI. This is a tiny, under-the-radar property and casualty insurer with a market cap sitting right around $398 million. And like we mentioned earlier, they are currently paying out a really attractive 5.09% dividend yield. Now, they might be a small player, but they operate in a very specific and frankly fascinating corner of the insurance market.
Global Indemnity focuses heavily on what the industry calls excess and surplus lines, E&S for short. Basically, these are complicated, high-risk insurance policies that the big standard carriers simply won't touch with a 10-foot pole. By underwriting these incredibly tricky, high-risk properties, they operate in this niche market that demands some serious, specialized expertise. But on the flip side, it also means their business model is inherently tied to really volatile, unpredictable situations, which perfectly sets the stage for understanding their somewhat chaotic financial performance.
Now, before we rush out and call this a safe bet, we absolutely have to uncover the hidden dangers that the financial press totally misses. Let's take a hard look at three major red flags. First up, we have a pretty stark contrast in their earnings per share. Now, if you look at their 5-year average EPS growth, it actually looks decent, a solid positive 36%. But their most recent quarter, they saw a violent 19% crash. So this isn't your steady, predictable dividend growth stock. This thing is a total roller coaster. And honestly, this kind of wild, erratic earnings behavior is exactly the sort of thing that scares off institutional money. Red flag number 2 is the dirty laundry you're definitely not hearing about on the news. $18 million. That was the shockingly large verdict handed down against Global Indemnity in a bad faith lawsuit. And get this, here is the real kicker. This whole thing stemmed from a case for the company's initial claim offer was a measly $5,000. Yeah, I'm guessing the jury really wasn't impressed with that lowball offer because they slammed them with an $18 million verdict for breaching contract and acting in bad faith. That highlights a potentially toxic claims culture, which is just a massive reputational risk. And that brings us to the crucial third red flag, what I call the private equity overlord risk. As a minority shareholder here, you basically have zero say against Fox Paine and that other top holder. You are entirely playing their game. And remember,
private equity firms always have a shelf life. They're sitting on a ticking exit strategy clock. Eventually, they're going to need to cash out, and exactly how they decide to do that, well, it could completely make or break the everyday investor.
But hey, if you can stomach those risks, the flip side here is genuinely mouthwatering. Let's pivot for a second and check out 3 massive green flags.
First off, consider our current era of high interest rates. It is absolutely crushing companies that are burdened by heavy borrowing costs. But Global Indemnity? They are a zero-debt fortress. Having absolutely no long-term debt means there are zero interest payments eating into their profits. And even more importantly, it gives them incredible dry powder. They have the financial flexibility to just swoop in and buy up weaker competitors at absolute fire sale prices during the next tough hurricane season. It's a huge advantage.
Green flag number 2 is what we'll call the Benjamin Graham discount. You know Graham's famous formula for intrinsic value, the Graham number? Well, for this company, it comes in at roughly $42 per share. But remember, the stock has been trading way down around $27. That huge gap gives you a massive 36% margin of safety. When you pair that up with the 0.57 price-to-book ratio we talked about earlier, it just completely reinforces the fact that you're picking up these assets at an extreme bargain.
And the third green flag? That would be their phenomenal underwriting turnaround. So in the insurance biz, a combined ratio below 100% basically means you're actually making money on underwriting operations. Global Indemnity recently posted a 95.1% combined ratio. That is an absolutely incredible 16-point improvement. And the best part? While you're sitting around waiting for the rest of the market to wake up and recognize this turnaround, they're comfortably paying you a 5.09% dividend backed by an 8% growth rate. Essentially, they are paying you to be patient.
Okay, so let's weigh this out. We've got a huge discount in zero debt in one corner, going head-to-head against volatile earnings and a controlling PE firm in the other. It is time for the ultimate value face-off.
If we run this exact setup through the lenses of 3 investing legends, the split is super fascinating. Benjamin Graham looks at that 0.57 price to book and gives it a definitive buy. To him, it's a textbook net play. But then you have Peter Lynch. He looks at that recent 19% earnings crash and immediately says sell or avoid. He notoriously hated volatile, erratic earnings. And finally, Warren Buffett, he'd likely toss this right onto his watch list. I mean, he'd definitely smile at the zero-debt fortress, but he'd probably hesitate at the mediocre 5.23% return on equity. He'd probably view the insurance side as way too much of a commodity, at least until they can prove they can improve those capital returns. And that, my friends, brings the tension right back to the ultimate catch. The elephant in the boardroom that we touched on a few minutes ago, the private equity exit. For regular retail investors, absolutely everything ultimately hinges on how Fox Paine decides to cash out that massive 43% stake. This is the single overarching variable that will dictate whether this investment becomes a massive win or a super painful trap.
It is a really severe binary risk. Look at it this way. If Fox Paine manages to find a strategic buyer to acquire the whole company, that buyer is almost certainly going to pay a premium to book value. If that happens, the stock could just rocket instantly toward that $42 Graham number. But, and this is a big but, if they can't find a buyer and they just decide to dump their shares in a secondary offering on the open market, well, this cheap stock is going to plummet, and it's going to get a whole lot cheaper before it ever gets better.
So what is the final verdict for this explainer? Look, Global Indemnity is an undeniable bargain for deep value hunters. You are getting an A-rated insurer with zero debt, a 5% dividend, and a massive 36% discount to its intrinsic value. But you can only reap those rewards if you are totally willing to accept the role of a passive passenger on a private equity plane. You really don't know the pilot's final destination, and you have absolutely no ability to change the flight path.
This is definitely for sure not a stock for the faint of heart. It takes serious patience to ride out that earnings volatility, and it takes bravery to stare down a massive controlling shareholder. So I'm going to leave you with this final thought to chew on today. Are you brave enough to buy into this deep value insurance play and ride the coattails of a PE giant? Or is the underlying risk of an open market share dump simply way too high a price to pay for a bargain?